Hi, everybody. Kathleen Brooks here. I'm the research director, obviously, at XTB. Thank you so much for joining. It's been a bit of a roller coaster ride for some UK assets. We've had the budget. It is now over. We know what is going to happen. £40 billion worth of tax increases, the largest in a post-war budget ever. So it's been interesting times for Chancellor Rachel Reeves. Most of that has actually fallen on business shoulders. That's with the much bigger increase in national insurance employer contributions than expected. Likewise, we've seen VAT on private schools. We've also seen an increase in capital gains tax as well, although that wasn't as much as expected. Capital gains, that went up at the highest rate to 24% from 20%. Remember, a few months ago, there was speculation that it could go as high as 40%. So that was some good news there. Some tweaking to inheritance tax rules as well, not as onerous as some feared, and that really has benefited AIM shares. So they're the UK small stocks. A lot of entrepreneurs will list their companies on the AIM UK market, and that has absolutely surged today and has managed to maintain gains. However, there's been a bit of a turnaround in UK assets. Let's look at the pound first. So we'll look at our first chart, which shows the cable rate, which is the pound versus the US dollar. Now, this is just one day's price action, because I just want to show you the impact of the budget. So as you can see, we came into the budget, the pound was weakening. It was very, very low, close to one of its lowest levels of the year so far, as people were really worrying about the budget, about what it was going to expect, about what to be expected in it, growth fears, etc., etc. However, after that, as she started speaking, it then surged above 130, and now it's kind of settled in about the middle of where it was before. So I think that this budget is net neutral for the pound. And the reason why it's not really boosting the pound above that key 130 level versus the US dollar is because the OBR growth forecast. Now, we did mention this in our preview that was released at the end of last week. We said that the OBR and their growth forecast and their forecast for the UK's fiscal future would be the key thing for financial markets. And it turns out we were right. These OBR forecasts really are having a big impact on the market. Firstly, on the pound, and that's because the growth forecast, the GDP forecasts, right up till 2030, they were pretty unexceptional, to be honest. We've got growth peaking in the short term, so peaking next year at about 2%, and then actually retreating a little bit or moderating as we get into the latter part of Parliament at about a 1.6% rate for 2029. So the OBR have actually reduced their expectations for growth in the slightly longer term. Now, it'll be interesting to see what the Bank of England does next week when they release their monetary policy report. But without strong growth measures, the pound really can't rally back above 130, especially when we saw US growth today rose at 2.8% annual pace. The UK is nowhere near that, even with these revised forecast from the OBR. Now let's look at the second chart. Now, this really is critical. This is 10-year bond yield. This is a year chart, but as you can see, bond yields have been climbing today. Now, it was a bit of a roller coaster ride for bond yields, because what we've seen at the start of the day and during the budget speech, we saw bond yields come off. The bond UK, remember, yields move inversely to price. So as yields came off, bond prices went up. The bond market in the UK was really outperforming Europe and the US. However, it reversed course. And again, it was down to the OBR. What they said was this was a big tax budget. It was also a big spend budget. And they estimate that the fiscal loosening, so the fiscal largesse, will lead to much more debt issuance in the UK to the tune of about over £30 billion a year. Now, that is a massive number. So there's going to be more debt flooding the market. And of course, it's supply and demand, isn't it? When there's more supply, the price will go down. And because it's bonds, the yields will go up. So that's exactly what we're seeing here. What we're seeing, what this also means is even if the Bank of England does cut interest rates next week as expected, that's not having such an impact on the bond market at the moment. Globally, bond prices are rising in the US and in Europe, and we think that is down to a few things, but mostly down to government deficits and how much governments are planning to borrow. It's also worth noting that with the US presidential election next week, we think the global bond markets will trade on the downside, so yields will probably be biased to the upside in the coming days, and that's because both candidates in the US are expected to increase the size of the US deficit. So yes, UK bond yields are rising on the back of the OBR forecast for more debt issuance for the UK, but it is a bit of a global thing, so we can't blame it all on Rachel Reeves. Now, the last thing I want to show you is the gold price. That's chart 3. And as you can see, absolutely fizzing. Gold has made another record high today, and we think that it will continue to rise as we lead up to those US elections. So in an environment where the bond market's been shaken up a bit by chancellors and by budgets and by new presidents, everyone's flocking into gold, and we expect that to continue. So that's it from me. Thanks everyone for joining, and we do appreciate it. And we will speak to you very, very soon, definitely over the US election. So please join us then. Thank you.